Credit Suisse has a prime brokerage survey where they interview 300 of their allocators, and the top strategy demanded by hedge fund allocators in 2018 is emerging market equity, and it's a huge surge from last year. Obviously, emerging markets had a killer year last year. So you're a hedge fund manager who's going to take advantage of this appetite, but obviously, emerging markets are kind of in the center of all of this trade noise that we're dealing with headlines every single day. So I'm curious, how are you navigating in this very noisy trade policy world we're in?
Oh, well, thank you, Katya. I would say, first of all, I'm pretty optimistic that the trade spat with China can be resolved, mainly because the things that the U.S. wants are also what China wants for its own policy objectives. So once again, we may have a situation where China wins. They want to open up their financial system to foreign investors. They want to open up the rest of the service sector. They want IP, intellectual property protection, because now they have intellectual property worth protecting. They've also this idea of exchanging market access to their billion-person market in return for U.S. firms and foreign firms giving them their intellectual property, that horse has left the barn. Much of that has already been done, and that damage has already gone on. Now we see that the top academic articles in neural networks important for artificial intelligence are coming out of China, right? So they have their own indigenous intellectual property. So I think, first of all, that that might be settled a little more easily than we think. The other thing is countries we're in generally are not as disturbed by these international trade spats that right now are focused on China and then, of course, NAFTA.
So perhaps you'd give us an idea of the profile of your book then, so we have a way to navigate.
Yes, so first we choose countries, and then we do put a lot of blood, sweat, and tears into choosing companies within the countries. So we're very heavily overweight India. We're also overweight Brazil. We also have some positions in Mexico, which is a little bit different kettle of fish, as well as some of the ASEAN countries and some North Asia.
In terms of how emerging markets are going to be faring in a rising rate environment, do you have a view on whether they'll continue to perform well?
Yes, they always do well when the dollar is weakening. But in the last 4 times that the dollar that interest rates have tightened, the emerging markets have done very well. The only time they didn't was in 1993, when interest rates went up very quickly and unexpectedly. But when interest rates are tightening for normal reasons, we're not really very fearful. The dollar's also either fair valued or overvalued, so I don't really see the dollar rising tremendously and derailing the emerging markets currencies.
So how do you immunize your portfolio from the volatility of all this headline risk?
So volatility itself, is the new feature of 2018, but the headline risk, meaning on macroeconomic policies, we try to choose countries where the macroeconomic policies are reasonably constructive for us. And so you can never, if there's a war in Syria or something very dramatic, there's nothing we can do about that. But in terms of the countries we choose, we try to choose countries that have reasonable policy trajectories.
You mentioned Brazil, that you're overweight Brazil. Obviously, they have a big election coming up. There's a lot of question marks still about who's running. I'm curious, you're a long-term investor. How do you get comfortable in this environment, investing in Brazil?
Yeah, so I think for Cartica, Brazil is a story of cyclical recovery. They had a terrible recession, and we're now having a cyclical recovery from that. The other thing is the cost of capital falling in Brazil is one of the big stories in the emerging markets. The interest rates went from 14.25% to 6.5%, and the CDS spreads got better. So you had an amazing tailwind of lowering of the cost of capital. We love to find that in the emerging markets. In addition, in terms of the election, the main issue the market is focused on is pension reform. And our view is that any candidate that's elected is going to be somewhat hemmed in by the fact that they've got a very big fiscal deficit of between 7 and 8%. And that is going to constrain how they can move. And they're going to have to do some pension reform because they have no excess budget to allocate to anything discretionary.
So no matter what, it's a bullish scenario. Are you adding?
Yeah, so I think that what we found is before elections, markets tend to go down in the spring and then up in the summer before the elections in the fall. So that pattern might hold out. But as long-term investors that will ease into positions, we are still looking at Brazil to allocate today.
Now, you're pretty activist, which is fascinating when it comes to the developing world. How do you become activist in countries, which maybe are not used to activism traditionally? I mean, the U.S. is very used to it, but, emerging markets, not so much.
Yeah, so in the emerging markets, about 85% of everything listed is a controlled company. Someone owns 51% or more. So we have to be in conversation with the people who control those companies, and we have to persuade them. We have to be constructive activists and persuade them through analysis that they should change some policies, behaviors, sometimes their board composition in order to create value in their companies. And they usually want to have their company be more valuable, so it works quite well, actually.
And those are usually states or families, and they're open to change?
They're usually families, so 75% are family and founder. And one study showed over a 10-year period, family and founder businesses went up 10.5 times, widely held went up 1.5 times, and state-owned enterprises went up close to 0. So that's why active investment beats passive in emerging markets. You can choose not to be in state-owned enterprises, choose not to be in widely held enterprises, but have a really good relationship with the families and founders that are your interlocutors making the decisions to make companies better.
The other main question for your positioning is how do you manage the currency risk, right? And we're seeing a lot of currency fluctuation these days.
Yes. So generally that's part of Cartica's selection of a country where we think that the currency is going to go. And in exceptional cases, we will hedge the currency at least for a period of time and to some extent.
And we saw with Mexico when it comes to currency, Mexico has, the peso has rallied a solid 9% against the dollar this year. It's the top performing currency in emerging markets. Can you talk a little about, they also have an election coming up, a big one in July. And there's a market unfriendly candidate in the lead there. So how does that influence your investment decisions and how you're thinking about the companies that you currently own there?
Yes, so Lopez Obrador, the market unfriendly candidate, did govern Mexico City, and when he did, he was fiscally responsible, he was quite pro-business, he put in infrastructure, and we've spent a lot of time with advisors to him. I would say that some of his policy pronouncements have been contradictory. What we really hope is that the main reform that the market has liked and we've liked very much is the oil and gas reform. He will not have Congress with him, and so he will not be able to completely derail those reforms. And so I think that's going to be one of the most important things.